Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, May 19, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had an interesting development today. Last night, and I believe the night before, we discussed the importance of the 237.70 number. And the reason that's an important number is because that gets us out of the most bearish position that the S&P or the SPDR can be in, and it puts us back up into the upper range. We talked about these pivot lows, and I said we need to close on a daily chart basis back above that level in order to essentially negate the down day from Wednesday. It doesn't negate the down day so much as it's not as important as it was on Wednesday. There was some damage done to the market on Wednesday, and certainly they had every opportunity to send the market lower. I'm not suggesting the downside is completely off the table at this stage of the game, but what I am suggesting is that the market is back in a bullish position. It will be in a better position if we close back above the 20-period moving average, for sure. However, the importance of 237.70 can't be taken lightly, and this market can grind higher. Now, we could certainly come back to back test the 237.70 number early next week, maybe Monday, right out of the chute. That's certainly possible. We could even trade a little bit lower. But the close today back above that number cannot be taken lightly. It is an important development for the SPDR. Now, if by chance we do come back down with a hard sell, nothing changes. We're still going to find support in that $234, $234.50 neighborhood. Down in this zone, right in here, is where the market will generally find support. So nothing's changed from the downside if we do continue to sell into next week. However, very important development with today's close. It's a positive development for the market. Let's talk about the bigger picture. The bigger picture is this market can and most likely will grind somewhat higher into at least the month of June, potentially even farther. So this market's just not ready to go down yet. We'll talk about cycles in a second. Well, forget about a second. Let's talk about it now. So when a cycle, and a larger cycle at that, is getting ready to make a turn, and that's what I believe is happening in the market now. However, it's not today. It's not next Monday. It's sometime in probably the latter part of June or maybe even into July is when I expect the market or the cycle turn to really take hold. A lot of times into larger cycles, a market will trade up into a cycle turn or down into a cycle turn. And what I think we're seeing here is the market fighting the upside, meaning trading up into the cycle turn. Actually, I guess it's more fighting the downside, meaning it wants to trade higher into the ending of this larger term cycle. Now, there's a lot of convergences or confluences, I should say, of cycles. But there's a couple of things that I think are important to point out just from a larger term perspective or longer term perspective, things that we should be aware of. And some of the longer term cycles that we should be aware of as traders or as investors is a 10-year cycle, and the 7th year of a decade is another important year. So we're in the 7th year of a decade now, and if you think about it, when's the last time the 7th year of a decade was in 2007? Does anybody think that that was an important cycle turning point, or just turning point for that matter, in the market? We had a big downturn in 2008 into 2009. The market really topped out towards the latter part of 2007. I would say that was an important day or an important time frame, and that was the 7th year of a decade. And not only that, but we're 10 years forward from that point in time, hence the 10-year cycle. Okay, beyond that, there was it wasn't as important, but there was certainly a correction 10 years before that. 1997 saw at least a 10% correction in the market. And these things are important, and they repeat over and over and over again. If you go back 10 years from that point, 1987, we all at least know about 1987. That was a stock market crash. I'm not suggesting a crash. I'm just suggesting there's going to be a real correction coming this year in the market. So you have the 7th year of a decade, 87, 97, 2007, 2017. We'll see. You have the 10-year cycle. If we go back 10 years, we have 2007, we have 97. It wasn't that big of a correction, but there was a correction. You have 87, and you can go back in time and check me on this work. You can do the work for yourself. Don't take my word for it. There's other work that I do that supports the case that this year we should see a more meaningful correction than we've seen in quite a bit of time. We should see that take hold or grip the market at some point during this summer, and my guess, it's not a guess, but my vote is for early summer. That being said, I don't think we're finished with the upside, so I wouldn't be surprised to see still yet again new highs. We still have some numbers that are on the table that I expected to be hit last week that weren't hit yet, namely $241 wasn't hit. I still think that number is very valid and can be hit. And then there are higher numbers all the way up to $246 on the spider. That's still not out of the question. We've seen this before. You get a spark in the market. Next scene shows we're up another 50, 60, 70 handles in the S&P. Case in point, and we've done this before. We talked about this even before it happened. Okay, from down here, okay, to up here was 4 weeks and about 80 or 70 or 80 handles in the S&P. I haven't done the math. Hold on. Yeah, it was 80 handles in the S&P. So, we've seen this before, and we'll certainly see it again. So we can't be surprised at the upside that can take place in this market. Certainly, if we get any kind of a spark from whether it's tax cuts or something else going on that can certainly spark the market, we can certainly get to new highs again. It's definitely not off the table. In terms of resistance on the upside, we talked about the downside. We know 234, 234.50, 233.75, in that neighborhood, the market will find support. That's item number one. On the upside, okay, as long as we get above and start trading above first hourly, and then if we get a daily close above, and it's really not far away, obviously, the 20-period moving average, which is the red sloping trend line, then the next major area of resistance is going to be the gap fill that comes in at around $240. That will be a major area of resistance to the market. If and when we can get above that level on a daily chart closing basis, then we're going to new highs and we're going to reach some of the numbers we discussed before. All right, let's go over to the IWM. The IWM was up today, but it was actually up less on close than the spider was. So there's still some kind of divergence going on with the IWM. On a day when the spider was up 0.75%, the IWM was up less than 0.5%. So the way I look at it is that's a negative divergence, and the IWM, and it's not negative in the sense that one index is down and one index is up. I'm just saying it's lagging the index, it's lagging the S&P, and generally speaking, if the market was strong, okay, the IWM would be outpacing the spider on the upside. So this is something that we need to be aware of, we need to be cognizant of, we need to take into account. We're not going to just take today and today's only activity away and say, oh no, the IWM was up less than the spider, the market's going back down. As I said before, we can certainly retest some areas on the downside. However, I do think that today's close was important and needs to be paid attention to, but by the same token, we look at all sides of the market, we look at everything, we put it all on the table together as each piece of the puzzle goes together, and this IWM piece is saying, not just yet are we ready to take off again to the upside. We're not leading, the IWM is not leading the market to the upside, so that needs to be watched, and I am watching very closely. In order for the IWM to get back into a somewhat bullish mode, we need to get back above and close above the 50-period moving average. We'll just call it 137 for argument's sake on a daily chart closing basis. Until and unless that happens, then this is going to put in a bearish pattern which will promote more downside. The longer it goes sideways below the 50-period moving average, the deeper the downside can become. So we're going to be watching this very closely next week for sure. Heading over to the transports. Same discussion from last night. The transports are in a very similar position that the IWM is. We're making a bearish pattern potentially, and we will continue to unless and until we can close above this red candle high that comes in at 9,005. It's 9,004.73. We need to close above that on a daily chart basis in order to take the bearish pattern off the table. And then, of course, we need to get above and trade above on a daily chart closing basis the convergence of these moving averages, the 20 and the 50 period moving average. So the transports and the IWM have a lot of work to do to get back in a bullish position. Now, even if we make new highs in the S&P, okay, at this stage of the game, I wouldn't be surprised to see the transports and the IWM not necessarily make new highs, and that would be another shot across the bow. And Wednesday, down day, by the way, was a shot across the bow. But that would be another shot across the bow that the market isn't necessarily healthy across the board, and also supports the case that we're going to see a more meaningful correction during the second half of this year. So I'm watching these two like a hawk very, very closely. They are the leading indicators, in my opinion, the transports and the IWM. All right, let's go over to gold. We'll talk about the shiny yellow metal. And in the gold market, we had a little bit of a recovery today. The low happened to be the 20-period moving average, and that actually happened last night, meaning it happened Thursday night when gold reopened, and we made a steady climb higher into the 200-period moving average, which is basically where we closed the day. The 200 comes in at 1255, and we're at 1255.2. Same story really from yesterday. Are we going to put in a bullish pattern that would signal higher prices coming? That would mean we're building energy for another move higher, but it needs more time. We would have to go sideways, back and forth, probably another 2 or 3, potentially 4 days next week. And that would be enough energy to set gold on another move higher, trading up most likely into the $1,280 area. Next area of resistance is 1,270, and then after that, the 1,280 area. But right now, all we're doing is back and forth, and we'll have to see whether or not gold stays inside this green up candle, and if it does, then it's consolidating to build energy to move higher. Any close below this low on a daily chart, which comes in at 1236.30, any close below that number, and likely scenario is, first we obviously go down, well maybe it's not obvious, but first I think we go down to double bottom, and I don't think it holds. I think we then go down to 1200. That's if that green candle low does not hold at 1236.30. Next market we'll take a look at is the silver market, and we had a nice healthy update today, recovering yesterday's loss in the silver market. That's a bullish sign. But on the upside, we're going to have to get above 1703 in order to promote higher prices. Otherwise, that'll contain the market. This is not a pattern of strength in the silver market. This is actually a bearish pattern. This is really just a big 3-week sell and a dead cat bounce. If we can get above this candle high here, this 17,035, if we can close above that level on a daily chart basis, then we can have something cooking up to this level here. The next level of resistance would be 1729. Until and unless that happens, then the likely story is there could be downward pressure in the silver market. However, likely scenario is gold and silver, not necessarily on an everyday basis, but likely scenario is they're going to trade together in large part. Next up, crude oil. Saw a nice healthy update today in crude oil. We don't need these fibs. And frankly, I didn't think crude oil had enough in the tank without more consolidation to go higher. However, that was wrong, and we did continue higher today right out of this consolidation zone. So the next area of resistance is going to be 51.27, and then the 200 period moving average will provide a lot of resistance at 52.18. We can actually trade slightly higher, 52.25 to 52.5. But if we did that early next week, that would really be an overbought condition, and that would likely stall out the market at that resistance zone. Call it the 200 period moving average or slightly above. And the likely story is we would have to pull back from there. The 200 should be resistant to the market. Up almost 2.5% today. Pretty stout, pretty good day for crude oil. And remember the other day on Wednesday when the stock market took a hit and crude oil didn't. I think I made mention of the fact that that was interesting. And generally speaking, when you see that kind of a divergence, and generally speaking, I don't like to marry together or correlate markets, as you know. However, generally speaking, if the market's getting hit pretty hard, crude oil generally gets thrown out with the bathwater as well. And that divergence, the fact that crude wasn't getting hit with the market, was a signal that something else was going on. And this today, we saw what else was going on. Crude oil had higher prices in store. Next up, the bond market. The bond market continues to levitate, and one of the main reasons why I like to discuss the bond market is because the bond market, much of the time, and I'm not doing a correlation here, but much of the time the bond market is indicative, or what the bond market is doing, I should say, is indicative of things to come in the stock market. You know that I've said this time and time again. The bond market people, the bond traders, are much, much smarter market participants than the stock market participants or the stock market people. All right. So net, bond traders are more astute and smarter than the stock traders. That's just the way it is. Okay. They can generally sniff something out long before the people that are equity traders have any idea what's going on. So go back to Wednesday. We had a big down day in the stock market. We had a big up day in the bond market. That's fair enough. Doesn't have to be correlated all the time, but that's not uncommon by any stretch. So that's normal market behavior. That happens a lot. Then yesterday we had a somewhat of a pause day, didn't do much. And today we had a big up day in the stock market. It wasn't tremendous, but it was a nice, healthy up day. Did sell off a little bit at the end of the day, but I'm going to attribute some of that to options expiration. But we had a nice up day today, good positive close in the stock market, and the bond market was still up a little bit, right? So again, just the fact that Wednesday's day was a large up day in the bond market, if all things being equal, you would have expected a sell-off in the bond market today, and we didn't see that. So that leads me to not necessarily the conclusion, but it leads me to thinking that I need to take this puzzle piece, I need to put it on the table, I need to be aware that there could be something under the hood, okay, that we need to see, that we're not just seeing right in front of our face. So we need to be aware that if the bond market is levitating and the bond market is trading at least flat to higher on a day when the stock market is higher, when Wednesday it was the exact opposite, It's something we need to pay attention to. And if the bond market's going to continue to trade higher, it may be a signal of something more to come in the stock market. Again, doesn't have to be tomorrow or Monday. Doesn't have to be Tuesday. I'm just taking all this information in. I'm culminating it. And at some point in time, in the next month or so, all this is going to come to pass. And all this information is going to provide one hell of a trade in the second half of the year. That I can tell you. All right, next up, the dollar. And wouldn't you know it, we hit the number that I put on this chart, I don't even know when. The 96.97 number has been on this chart for as long as I can remember. Okay, and today's low was 96.965. And we closed at 97 on the button. It's funny how that works, isn't it? Now, the other day, I thought we were putting in a low. We had an up day yesterday. However, today we hit the number, and I think it's fascinating and interesting information. And from a longer-term perspective, I think this low is going to hold. Okay, we could certainly trade a little lower, but all in all, this is the zone where if you're interested in being long the dollar, this is your buy price right down here. We could obviously trade a little lower here and there, but this is the zone where if you're interested in being long the dollar, this is where you take your shot. This 96.97 area should hold. It's an important number on multiple time frames. It's an important number for multiple reasons. We should find, at minimum, of daily chart support down here at this number. And by the way, we'll see if this works out to be anything significant, but from previous pivot high to today is 7 days. We'll see if that holds water next week. And with that, I'm going to leave it there tonight. It's everything I wanted to discuss. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.